Hi and welcome to Swissquote's Daily Market Talk. It's Friday, September 12th. This week's economic data from the US gives the green light for a rate cut next week from the Fed, boosting appetite in global stock markets, which are also backed by AI rally on news from not only the American companies this time, but also the Asian peers. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So in just one sentence, yesterday's fresh data from the US gave the green light for next week's Fed cut. It's not that the inflation data from the US would matter much at this point in time when all of the attention is mostly shifting towards the weakening jobs market in the United States. But yesterday's CPI figures from the US, which were mostly in line with analyst expectations, combined to a jump that we saw in initial jobless claims, gave full justification for those who are actually craving for a Fed rate cut next week. And two more rate cuts are fully priced in as well before this year ends. So that's the good news. The bad news is, unless a Fed member hints otherwise at the very last minute, as it has been the case last September, remember that the Fed will be cutting rates by 50 basis points, well, next week's rate cut will be just limited at 25 basis point cut with more than a 90% chance given to that scenario by activity on Fed funds futures versus just 7.5% chance given for a 50 basis point cut. And the reason for that is the tariff and weather related price pressures were still visible in US consumer prices across many categories actually in August, including coffee prices, for example, that jumped 20% in a year, beef prices that registered more than 16% rise, and apples that rose nearly 10% compared to the same time last year. As such, both headline and core inflation numbers from the US rose, and they rose to the highest levels this year. It's just that we haven't seen a significant spike, a significant jump in these inflation figures like the one that we've been seeing in the US jobs data since more than a month now. As per the big jump that we saw in jobless claims yesterday, that spiked to the highest levels in 4 years, the highest level since 2021. Well, many actually see it as an additional confirmation of the crumbling jobs market in the United States, in addition to the weak NFP numbers, while some actually warn that the claims mostly spiked in Texas and they have declined elsewhere, which is much less disquieting than a broad-based increase in jobless claims everywhere. But long story short, inflation in the US isn't spiking as fast as the US jobs are crumbling, and the latter justifies rate cuts at the Federal Reserve, but at a cautious pace. Inflation risks have not evaporated, and any sudden stress that we might see in inflation numbers could eventually spoil the dovish Fed expectations. So the US 2-year yield is about where it was standing yesterday morning just before the CPI data release in the US. The US dollar tested but failed to clear offers near the 50-day moving average, while the S&P 500, of course, took well advantage of yesterday's data cocktail to throw itself to a fresh all-time high level. And it's quite funny because on one hand, the strong earnings season among the S&P 500 companies makes investors quite happy about the company's health in the US, but on the other hand, the weakening jobs market, which is weakening economy, and prospects of lower interest rates actually boost valuations. So it feels like all news are good news for the moment and for the markets, obviously, and whatever hits the market, whatever hits the headlines in terms of economic news, well, there is only good vibes. If news are good, it's good. If news are bad, well, there's the Fed. So across Atlantic Ocean, the central bank those were much less enthusiastic. Remind you, the European Central Bank maintained its own interest rates unchanged yesterday, as it was widely expected by analysts around the world. And the ECB chief, Madame Lagarde, said that economic risks to the Eurozone economies are abating, while inflationary pressures are contained, but deflation is certainly gently over. So in simpler words, it means that the European Central Bank is now not thinking of lowering the interest rates any further. And the probability of another rate cut from the European Central Bank before the middle of next year actually fell below the 50% level from above 60% before yesterday's meeting and yesterday's press conference. Happily though, the Stoxx 600 also enjoyed the dovish Fed expectations and the global positive echoes of upcoming rate cuts in the United States, but the euro-dollar rebounded from its 50-day moving average yesterday on this clear divergence between the more dovish Fed and more hawkish ECB expectations. So this divergence between the ECB and Fed, though mostly priced in the market prices, continues to support the euro-dollar bulls right now, yet resistance remains solid near the 118 psychological mark as the French budget concerns obviously remain somewhere on the back of investors' minds these days. Elsewhere, gold continues to benefit from the dovish Fed expectations, which lead to a softer US dollar and softer US yields, and also uncertain geopolitical setup across the globe as the price of oil is now pushing higher again this morning towards its record high levels, while US crude ignores the rising tensions between Russia and the NATO countries this week after Russian drones violated the Polish airspace earlier this week, remember, waning whatever was left of peace hopes for Ukraine. So the barrel of US crude slipped below the $62 per barrel support this morning, and next support is seen near the $60 per barrel level. In Asia, well, the Chinese equities had a blast this week, with Alibaba adding 8% yesterday on the back of an announcement that they are looking to raise $3.2 billion in convertible notes and use about 80% of this new capital raise to strengthen the data centers. And the remaining 20% will go to its international commerce efforts. Now, normally, note that when a company raises money, well, it's just perceived as negative news from investors and the stock price generally reacts negatively to the news. But in the case of Alibaba this week, well, investors are rather happy, they're quite happy actually, to hear that the company is now investing more in AI. That is now becoming the company's biggest revenue stream, especially the most promising for the future. And that also given that the e-commerce platform suffers from domestic weakness in China and also trade war outside the country. So what we saw yesterday is simply the reflection of the Chinese AI trade and appetite for more in Chinese AI trade. And as you know, I think that Alibaba is one of the best candidates to shoulder that AI rally for the Chinese companies. And despite a 140% rise since the beginning of this year, the company Alibaba continues to trade with a 50% discount compared to its heydays back in 2020. And the fact that Alibaba will probably opt for local chips rather than the US counterparts, if nothing by fear of losing Beijing's love and support, while the local chip makers in China are also having a good time this week, with SMIC up by around 10% this week alone. Elsewhere, speaking of chips, well, the Korean SK Hynix also jumped nearly 7% today after the company announced that they actually completed the world's first HBM4 development, which is a technology that stacks multiple memory chips on top of each other vertically with very wide input-output paths, allowing move large amounts of data very, very fast and with greater energy efficiency than many other types of memory chips. And that, well, they are now ready for mass production. In case you are still looking for opportunities outside the US technology companies, well, SK Hynix PE ratio is just around 7. So this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below, as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week, and until then, good day trading and have a lovely weekend.